Good morning, everybody. We're just doing a quick sound test. If you can type yes, if you hear what I'm saying, that would be great. Hello, everybody. Thank you for joining our learning series, Navigating New Roads. Today's webinar will be presented by Daniel Mayo and James Trubenbach-Byrne to discuss PPP forgiveness considerations for not-for-profits. Before we begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located on the right hand of your screen. At the bottom of the toolbar, you will see a question box. All questions pertaining to the webinar content should be asked there. We will do our best to address them. Be sure to answer all 4 of the polling questions to ensure that you receive CPE credits for today's session. Once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. And finally, to raise the stakes a bit, at the end of each of the 7 sessions within our Navigating New Roads learning series, we will have a trivia question for you to answer. The attendee who answers the most trivia questions correctly at the end of the series will receive a special prize from our Withum team. And with that, I'm going to turn it over to Daniel.
Thank you, Ashley. So thank you everyone for joining us today. We're pleased to have you here for our webinar. My name is Daniel Mayo. I'm the National Lead for Federal Tax Policy at Withum. I'm a tax lawyer by day, but lately I spend all my time on the PPP and the loan forgiveness process, the application process. It's as you can imagine, it's an all-encompassing thing. And with that, let me turn this over to James. He can introduce himself, and then we'll get started.
I'm James Trubenbach-Byrne. I'm a manager in Withum's not-for-profit government and education niche, and then specifically most of my clients are in the state and federal funded arena. So that is kind of the key considerations we'll be looking at today when it comes to not-for-profit considerations.
Great. So we're going to talk today about loan forgiveness. That's the topic today. And so what we thought was we'll do a presentation for around 30 to 40 minutes, and then we'll open it up to Q&A. I noticed we've already gotten some questions, which is great. We'll answer them throughout the presentation or at the end. We'll try and mix them in if we can. Just want to make sure I can focus on the slides rather than the questions, but we'll definitely get to all the questions by the end. So loan forgiveness. So everybody's at this point has obtained a loan. They went through the difficult process of applying, getting the bank to push the application through, and now they're focused, turning their attention on the loan forgiveness process. So I guess that by now most people know the basics, so I'll go quickly through them, and then we can turn to the trouble spots. First, it only includes expenses that are paid or incurred during the 8-week period after the loan is made. So when is the loan made? The loan is considered made when the first advance is made from the bank to the borrower. So usually the loan comes in one installment, the loan proceeds. So if the bank deposits $100,000 in your account on a Wednesday, the loan is considered made on that Wednesday, and the 8-week period will expire 8 weeks later on a Tuesday. So this way it's a full 8-week period, and that period will change for every borrower depending on when your loan was made. There is some talk in Congress about possibly extending that period, but as of now, nothing's been extended. It is an 8-week period from the date the loan is made, but there may be more to come on that, given everything that all the press reports that are coming out about the difficulty people are having with spending the money, and the rules not being finalized, and there not being guidance yet on forgiveness. It's possible that may be extended in the next few weeks, in the next round of legislation. The list of eligible expenses includes payroll costs, and this is the same definition that you are all familiar with from the the determining the maximum loan amount. It's the same definition in the statute. It includes a salary and wages up to $100,000 per employee per year. The difference here between the forgiveness side versus determining the maximum loan amount is that for the loan amount, you use a monthly calculation, and for the forgiveness process, it is a weekly calculation. So when you take 100,000 and multiply it by 8 weeks and divide by 52 weeks, so by 8/52, you come out with that 15,385 number. That's what that is. So just as a reminder, payroll costs includes the wages up to 100,000, and there's other items such as group health care, retirement, state and local taxes, employment taxes. Those are in addition to the 100,000. So in addition to the 15,385, there's other items that are a part of payroll costs. So eligible expenses also includes interest on mortgages that are incurred before February 15th, and this includes when they talk about mortgages, the definition of a covered mortgage in the statute includes any mortgage on real property and personal property on which there is a mortgage filed. So in the case of real estate, we all know what a mortgage is. You buy a home, borrow money from the bank, they file a mortgage with the county clerk, which registers a lien against your property. In the context of personal property, that means a lien or mortgage means a UCC1, which is a document, again, filed with I think the state, if not the county, I think the state you file it with. And that document records the lien against the personal property. So if there is a UCC1 or a mortgage, then that will be a covered mortgage, and the interest on it will be included as long as the instrument was in place before February 15th. Rent under a lease that's in force before February 15th, and also utilities that began before February 15th. And utilities is defined in the statute as electric, gas, water, transportation, telephone, and internet. And so on transportation there, it's unclear what that means. And so there has been guidance from the SBA in one of their IFRs. The SBA has published to date, I think, 8 interim final rulings. So I casually refer to them as IFR Interim Final Rule 1 through 8. In one of those IFRs, they talked about gasoline for a rental car, not a rental car, a car that was leased by the business. So that's what, when we say transportation, we put gas there. I think that's what at least one example of what they provided as a transportation expense. There are certainly others, but that's one of them. I'll address 2 of the questions that came up since they relate to these eligible expenses. One was they pay unemployment taxes to a company, not to the state. So the answer is yes. If you use a PEO, a lot of companies use these professional employer organizations, you can still include these expenses. That would be part of payroll costs that can still be included even though you're not paying directly. And the next is someone said they've heard that, this question comes from Anne. I will only use first names here, so not to put anyone on the spot. She says, I've heard that office equipment leases qualify for loan forgiveness. And the answer is yes. If it's rent, it can be rent on personal property or real property. But keep in mind that those overhead expenses, meaning the interest on the mortgages, the rent, and utilities, those are limited to 25% of the total forgiveness amount. So that's 2 bullets down, where we say, and that's another limitation, not imposed in the statute, but imposed through one of these IFRs. I think it was number 1 or 2, the first or second one that came out. And so they limit, so when they say that no more than 25% can be non-payroll costs, they're talking about interest, rent, and utilities. And what really they're saying here is the government is paying the business to pass the money through to their employees. So this legislation was intended to prevent the unemployment rolls from swelling. And so what they said was to the businesses, we will give you money to pay your employees. And the way to think of this 25% limitation is compensation. The government's saying, if you pay your employees, we will allow you to forgiveness up to 25% of the amount that you can use for your own personal expenses, so your interest, your rent, and utilities. So I sort of explain it to people as that's the compensation you're being given by the government to pass through the expenses and continue to make the payroll for your employees. The forgiveness amount is limited to the principal amount of the loan plus interest that accrues on the loan. So that's something we also know from the IFRs. So that's the max. So if you borrow 100,000, the most you can be forgiven is 100,000 plus interest on that amount. That sort of makes sense. In The amount of forgiveness is reduced by certain headcount and wage reductions, and we'll walk through that calculation in a little bit. The statute, the CARES Act, which was passed on March 27th, also provides that the amount of the forgiven amount is tax-free to the borrower. So that's nice. That normally cancellation of debt income is taxable unless an exception in Section 108 applies. And the statute provides a specific exemption from income, so the forgiven income is not taxable to borrowers. On the other hand, the deductions that are paid with the forgiven expenses, so when you pay your interest, payroll, rent, utilities, to the extent you're using forgiven proceeds, that will not be deductible to the borrower. And the IRS issued a notice, I think it was 2020-32 that came out last week, and that clarified that the deduction will not be taken. So, and I think that's a fair result, somewhat an expected outcome from the IRS. What that says is, if the government's paying these expenses on your behalf, you do not take that amount into income, but you also don't get the deduction. And that makes sense from an economic point of view, since you didn't bear the expense. To give you tax-free income and then a deduction would be a double benefit. So that's what they're saying there. So there's no inclusion on the loan forgiveness amount, no deduction for the expenses that relate to the loan forgiveness. Other expenses continue to be deductible. And then there's going to be a documentation process. The borrower is going to have to apply for forgiveness at the end of its 8-week period. The borrower will gather up proof of its expenses that it paid, and will gather its payroll documentation, its rent, utilities, and bank account to show that the amounts were spent. And so then the application will be made to the lender, and there's no timeline yet, or no formal application, or even a calculation from the SBA. So we don't know how that's going to work. We expect guidance by mid-May, so within a week. We expect there'll be guidance on this process and the timing and the certifications. There may even be an application that is required to be prepared. If there is, I think it will include certifications. I think they're going to want to put people on the hook that the calculation they're giving the lender is under penalties of perjury, that the borrower certifies it's true, accurate, and complete, that sort of thing. But once that application, in whatever form it takes, is submitted to the lender will have 60 days, according to the statute, to process that application and make a decision on the loan forgiveness. Whether they allow dispensations from that 60-day period, we don't know. But as of now, they have a 60-day period. That it sounds like it's very short, and it is a short period of time, but keep in mind that it's a rolling 60-day period for the lenders, right? So as everyone's 8-week period ends at different times, and everyone will prepare their applications on a different timeline. So the lender will have more than 60 days in the aggregate, but as to any one application, they only have 60 days. So we can turn to the next slide, please. We get into the definition of payroll costs in further detail. And so when it comes to your employees, we talked about the payroll costs include wages, salary, commissions up to $100,000 per person. On an 8-week period, you multiply that by 850 seconds, that comes to $15,385 is the maximum. We know it does not include payments to independent contractors, but it does most likely will include imputed income for fringe benefits like housing and tuition benefits are included in the, if it's included in the W-2 imputed income amount as wages, it's likely included here. Again, there's no guidance on this, but this is what we think will be the rule. It's likely that the SBA will address this when they come out with guidance in the next week or so. Payroll costs also includes these other items that you should be familiar with from, again, determining the maximum loan amount. This is the same definition that was used there. It includes severance payments, dismissal or separation, vacation, family leave payments, payments for group healthcare benefits, including insurance premiums. And this can be a big number for a lot of institutions and not-for-profits, given the exploding healthcare costs in the last few years. Also, retirement benefits, so employer matches for 401ks, profit-sharing plans. The only limitation on all these benefits is that we tell people there is an 8-week limitation. So it wouldn't be appropriate to lump in your annual, if you happen to make an annual payment for healthcare benefits, let's say, you happen to make it during the 8-week period, we think you'll only receive credit for 8 weeks worth of the expenses, not the full payment, annual, the annual payment. And lastly, the employer, state or local taxes like the state unemployment, disability, usually not the biggest amount. Usually it's some fairly small amount for employers. On the sole proprietor side, we won't address that. I don't think that's really a big issue for not-for-profits. But on the partnership side too, it includes net earnings from self-employment, which is the amount taken in box 14A. That includes guaranteed payments for services. That includes partner draws that for active partners. They multiply it by the 0.9235, which gets rid of the self-employment tax, the FICA portion. And finally, as we know from the original calculation, the definition of payroll costs excludes the employer's share of federal employment taxes and excludes sick leave and family leave that's reimbursed under the Families First Coronavirus Response Act. And recall that's reimbursed with these refundable tax credits. And also compensation paid to employees whose principal place of residence is outside the US. So that's the definition of payroll costs. So we turn now to the polling question number 1. Ashley?
Polling question number 1. Which of the following are not included in payroll costs? Retirement benefits, dismissal or separation payments, group healthcare benefits, including insurance premiums, or employer portion of FICA. All right, keep on voting. Make sure you take all of the polling questions, answer all of them for your CPE. Give it another few seconds. Get in those last minute answers. And we're gonna close it out.
All right, most people got it right, which
Looks
is
like most people chose employer portion of FICA.
and that's the right answer. So great job. We'll turn now to the definition, the clarification of allowable versus forgivable expenses. And I'll start moving quickly here so we allow more time for the Q&A. There's always a tension in these webinars, going too fast, too slow. It's hard to draw to get the right balance. But we do want to leave time for Q&As. We know that's an important thing for many participants. So the loan agreement has certain allowable uses that the funds obtained in the PPP can only be used on certain things. And that's that first column of allowable uses during the 2-year period of the loan. And that determines what you're permitted to use a loan on. If you use it for anything other than that, it's a violation of the loan agreement. It triggers an event of default and requires an immediate repayment, as well as there could be other penalties. But that covers essentially going down that list. Payroll costs, which we talked about, interest on business mortgages, that's what we talked about, business rent and utilities. Same thing as what we talked about in the forgivable expenses, which is over to the right for comparison purposes, except there's no, on the allowable uses, there's no limit that it be in effect before February 15th. There's also 2 extra uses, which are interest on any other debt obligation with that time limitation and costs related to continuing certain benefits while employees are on leave and the premiums relating to that. So we just wanted to highlight this as this comes up a lot when people say, what can I use the money for? It can be used for any of these allowable uses, but if you want it to be forgivable, it's only those forgivable expenses on the right that are made during the 8-week period that will give rise to forgiveness. So this chart is a handy chart to pin on your desk if you think about this a lot, or keep handies because it's a good reminder of the differences between the 2 rules. Next slide, please. This is a very simple explanation. We'll go through how this 25% rule works. Start with that first column on the left, $100,000 loan amount, working our way down. The payroll made during the 8 weeks is $60,000. Rent, utilities, and interest, I call those the overhead expenses, are $30,000. So the total spent of the 100 was 90, and the amount not spent was 10. So we know right off the bat, regardless of what happens with forgiveness, 10,000 is going to need to be repaid since it wasn't spent. It can't be forgiven if it wasn't spent. Go to the next column, the maximum amount that can be forgiven. We know it's the 60,000 payroll. And then the question is, how much this overhead can we get in? We can't get the full 30 in because 30 over 90 would be 33%. Now we're exceeding that 25% limitation. So we have to reduce it. We do the math there, but it comes to 20,000. And so we're just doing a quick math. When you look at 20 over 80, right? 60 plus 20 is 80. 20 over the 80 is 1/4 or 25%. So in this example, the borrower spent 30,000 on their overhead, but only 20,000 will be forgivable. So what does that mean on the right? It means that 10,000 of it has to be repaid. So the borrower is going to have to repay 20,000 here, which is 10,000 of overhead, which is not forgiven, and 10,000 of the loan not spent, which is a 20,000. The important thing to highlight here, one is how the 25% rule works, but also that there's an actual cost here of 10,000 to the borrower. And when I refer to it as a cost, what I mean is the borrower spent some of the money, the loan proceeds, on its overhead, but it's also going to have to repay the bank for that same fund. So it will have to come out of pocket for $10,000 in this example. So this is why we caution people to start their planning and do scenario planning early in the process, because it's likely many people are going to be in this scenario where they've spent the money and also are going to have to repay the bank. And so we call that the cost. We have at Withum, we have our own scenario calculator, which we do we prepare for clients, and it takes about an hour or two of time. It's not a lengthy process. And then what we do is we highlight some of these things. Mainly, one of the most important things is this cost amount, which is how much of the loan, the amount that you spend, will you have to repay, and in this case, 10,000. So to the next slide, please. So loan forgiveness reductions, there's two main reductions. There's 4 reductions in total if you just want to think big picture, first of all. That 25% limitation is one reduction. The overall limitation of the principal amount of loan, that's another reduction. And these are the final 2. And these are the ones, when people say reductions, they talk about these 2, but there are those others I just want to highlight, level set everyone here so we're all thinking about this the same way. These are the headcount and wage reductions. And in a big picture, I won't go through the math here and get too complex with all these dates, because we have a slide here which you can use it and work through an example in your own time. But what it does is, if you reduce your headcount relative to a base period, and there's two base periods, you can pick the one that's best for you there. But if you reduce your headcount in the 8-week period versus those base periods, there's going to be a reduction in forgiveness. And so this is important. If you had 100 full-time equivalents in the base period, and you have 100 full-time equivalents in the 8-week period, there won't be a reduction. There's no reduction at all. The issue comes when you have 100 in the base period, and then you have 90 employees in the 8-week period. Right there, and you have a 10% reduction in headcount. So you're going to suffer a reduction in forgiveness of 10%. What that means is you start with the amount you spent, and then the 10% reduction comes off the top. So there will be a cost at that point. And that's what we talked about, why I mentioned that prior slide, the cost. In this case, the cost would be the amounts you spent on payroll and overhead, because the headcount reduction reduces everything. So you really need to manage this process. Make sure you're looking at you're comparing your full-time equivalents to the base periods. Note here, they're using a full-time equivalent concept, not the gross headcount that you use for determining the maximum loan amount. When you were determining the 500 employees, you had to count full-time employees and you had to count part-time employees. They all counted as one person. The full-time equivalent is a different concept. Unfortunately, the SBA has not defined how they're going to calculate FTEs, and we hope that will be in the guidance in the next week or two. But if you look online, there is a 2-page slide deck from the SBA, which seems to use a 30-hour concept for full-time equivalent. So the way the calculation works, at least according to this website and this slide presentation, if a company has an employee that works, say, 40 hours, they've exceeded the 30-hour threshold, so that's one full-time equivalent. So you take that person out of the mix. Then you take all your employees who work under 30 hours a week, and then you add their hours up and divide by 30. So the key part of this calculation, which is sort of not obvious, is that you don't add all the employees up, because if you had one employee who worked 60 hours and you put that person in the calculation, that 60 hours divided by 30 would give rise to 2 full-time equivalents when it's only one person. So there is a 2-step process. First, you take employees working 30 or more hours, they count as 1 FTE each. Then you do the bucketing approach of everyone under 30 hours, take the gross amount of hours for all those people, divide by 30, and that'll give you the number of full-time equivalents for that bucket. Then you add that to the number of FTEs that the individuals, and that'll give you your total FTE count. So that has to be done per pay period, during the 8-week period and during the base period. So that's how you do the headcount reduction. On the wage reduction side, this looks at we believe, on an employee by employee basis. And if any employee is reduced more than 25%, that gives rise to a reduction in forgiveness. So what this is saying is they don't want you reducing the compensation of your employees more than 25%. If you do, then you'll suffer a reduction in forgiveness. But there's a special rule here that says for this purpose, you don't consider employees making more than $100,000 a year. So if an employee made $400,000 and you reduced them to $10,000, that reduction would not count for purposes of the wage reduction rule. And finally, there's on that third bullet there, on the blue one, is there's this rehire rule, they call it in the statute. And this there's a window period. If there's any reductions in headcount, whether it's voluntary or involuntary, between February 15th and April 26th, I call that the window period, that there will be a reduction. If there's any reduction relating to people who left during that period, it can be cured by rehiring those people or restoring their wages by June 30th. And the SBA published FAQ number 40 a couple days ago, which is very favorable because it addresses a situation where employees are making more on unemployment than they were at work, and they're choosing not to come back. And this will have an effect on the forgiveness calculation for employers. So what they said was, if an employee was laid off, now they said laid off, not furloughed. Employee was laid off, he's given an offer, a written offer of employment to return to work at a comparable wage, and the employee rejects it. The employer can ignore that person for purposes of the headcount and wage reduction, as long as they document it. So this is a helpful rule that they issued, but it is somewhat narrow. The FAQ number 40 says that it will be addressed in a lengthier interim final rule, which hasn't come out yet, but should come out any day now. And so that is coming. So turn to the next slide, please. So this slide, I'm not going to cover it, but this is we run through the date. There's a lot of dates in the CARES Act, and it makes your head spin. So what we did here was we assumed the loan was issued on May 1st. We calculate the 8-week period. We worked through all these forgiveness dates, and I thought this would be helpful to have. I won't spend the time here because we're going to be short on time. We want to get to the Q&A section. But this will address a lot of questions you have about the dates, and we wanted to give one example that sets forth all the dates in one slide. Next slide, please. So this works through, this is another slide, again, you can look at it later, works through the wage reduction and the headcount reduction, and talks about situations where the loan will not be fully forgiven, because that will give rise to an actual cost to borrowers. So we really do stress that people should perform these calculations either on their own or with the help of their advisor. And they should be doing these calculations to learn what their forgiveness amount will be, so they don't spend too much and then not end up in a situation where they don't have sufficient funds to repay the amount of the loan that is subject to repayment that is not forgiven. So with that, the frequently asked questions, the SBA and Treasury have issued a tremendous amount of guidance in the last few months. Very generally speaking, there is the SBA issues these interim final rules we talked about. The Treasury Department issued frequently asked questions, which they update regularly, but it's at the same web page. They just update it every day or so. And then the Treasury also issued a document, another separate document. I co-wrote this article here, PPP and the Enigma of Loan Forgiveness. And this article doesn't explain the loan forgiveness process. We figure everyone had the general rules. What we do is we list all the areas of uncertainty. And we update this article regularly. So this was intended to be a running dialogue of the uncertainties and things we don't know. But at the bottom of that document, we just updated it yesterday. We list now all of the guidance that's come out, so with links to it. So if you're unsure what's out there, we do have links to everything that's been issued to date that's relevant to the PPP. We don't list the regulations for the SBA programs, but we do have all the guidance that came out recently with regard to the PPP. So if you want it all in one spot, it's in that article. With that, I'll turn it over to James to continue the discussion after polling question number 2.
All right, polling question number 2. Which of the following are not eligible costs? Payroll costs, mortgage principal, mortgage interest, utilities. All right. A lot of people voting, it looks like, for one of them. Get your votes in. We still only have 66% voted. We're looking for 100.
I'm happy to see most people are at least getting it right so far. The stats show very high percentage getting it right.
All right, and we're gonna close it out in just a second. Get your last minute votes in. And we're closing the poll.
So mortgage principal, 82%. Great job, everyone. With that, we'll turn it over to James.
Okay, so this section, what we're going to cover, and that affects most not-for-profits, is what would be considered a reasonable cost for the PPP versus state and federal awards, as well as contracts with private contractors like foundations. Just in general, some key terms and takeaways to look over. There's two main types of contracts we're going to focus on, and then these will kind of drive your decision. The first is your normal cost reimbursement contractor award, in which we receive a direct reimbursement for costs incurred for a specific program. And these contracts may include overhead costs in the budget or as an indirect cost rate. And then the other type of arrangement is your fee-for-service water contract, in which we receive a reimbursement based on quantity of service provided. So as we go through the examples, the breakout between these two will be kind of where we'll focus our attention. Just a general takeaway for everyone is that you can't charge both the PPP and a funder for the same cost. So if you include the cost for your PPP forgiveness, you can't go and also charge those costs to a funder. This is breaking as of 2 days ago, in that the SBA is not considering the PPP loans made to not-for-profits as subject to single audit. However, if you do receive funds under the EIDL program, they're going to be considering these direct loans from the SCBA, and therefore will be considered federal assistance that would go on your CFA. And then one other item to address before we go into it is the idea of whether or not organizations should be returning loan funds. In general, what we're recommending is that you kind of take a look at your operations and consider whether or not you would need to lay off employees if not for PPP, more so than just your general endowment that's available. What we would recommend for companies that are going to keep PPP funds is to document your good faith analysis of why you think and why you are keeping the PPP funds. With this memo, be sure to include any conversations you had with accountants, lawyers, etc., and kind of document your fact pattern, and to share this with the board, and if needed, to also get a board resolution for this. And then one more housekeeping note before we go into the examples. A question we get a lot administratively is how to track costs for PPP funds. What we would recommend for clients in the not-for-profit arena, since most general ledgers do include separate cost centers, we would recommend setting up a separate cost center for PPP spending. So the first thing we're going to cover is for the headcount determination that Dan just spoke about, how to adjust for this in terms of how you applied for PPP. So the key here is consistency. So there's two ways that organizations we saw applied for PPP loans. The first way was some organizations took all their payroll costs and then they looked at which employees were supported by grants and contracts and back those employees out in the initial ask for PPP funds. And then the other road was an entity just accumulated all of their payroll costs and included them all for PPP purposes. So depending on which road you went down, you would have to be consistent with that. So an example of this is if you had 100 total employees and 20 of which you knew were supported by a federal award, if you back those 20 out to only come up with 80 uncovered employees on your initial application, you should be only looking at those 80 employees when you do go and look at loan forgiveness. Those other 20 that weren't included in your initial application, we would consider not included in that. On the other end of the spectrum, if you put everyone into the bucket to start with in terms of employment numbers and headcount, we would recommend you include everyone in the final calculation, whether or not ultimately charged to the PPP loan. We would include those employees to keep it consistent. Just real quick, we'll do polling question number 3, and then we're going to get into the situations on whether or not what should be and should not be reasonably charged.
Polling question number 3, what is the maximum percentage of non-payroll costs allowable for forgiveness? 10%, 20%, 25%, or 50%? If you're experiencing any sort of weird issues with answering the polling questions, make sure you just pull your webinar out of full screen mode, and that should solve any issues if you're experiencing that. And we have about 70% voted. Please get your answers in. And we're gonna wrap it up in just a second. Closing out the poll now.
And it looks like everyone got mostly got the correct answer there, and that the maximum non-payroll would be 25% of your payroll costs. So going to the simplest example first, the organization backed out employees supported by awards from your initial PPP application. So in this case, the organization would have already decided upfront which employees were charged to a federal, state, or private award and excluded them from the initial calculation. So in this case, you would just charge any additional costs for general administrative employees as well as non-supported program employees with PPP funds. And then the other thing to look at here, though, is whether or not you backed out the initial overhead in that calculation. So you just have to make sure in this situation that cost for overhead that does get charged to PPP is not allocable to the piece that is federal, state, or private award funded. Situation number 2 is where most of the organizations will fall, is in that you did not back employees out supported by awards from the PPP application. So everyone was in the pool to start. So we have the breakout here of coming up of how to do this. The decision for ultimately how to find what costs are reasonable will depend on both the nature of your award and the current status of work on the awards. So fee for service and cost reimbursements will have different consideration. And the main key decision point to start with is whether work is continuing on the award or you're no longer able to perform the work based on the circumstances. So with that, for suspended programs, the first piece to look at is whether or not you have an established emergency policies and procedures. So if you have a policy that you would continue to pay staff with outside funding, even if you did or did not have the situation come up, then you can also charge them to your award. Additional guidance on this is that the OMB memorandum M 2017 also is going to allow recipients to charge cost of events, travel, and other activities necessary and reasonable for the performance of the award, or key here is also pausing and restarting of grant-funded activities due to the public health emergency to charge these costs to the awards. The only caveat here is that organizations will have to reach out to the funders for approval of such costs before charging them. And then if costs are not chargeable based on the criteria above to pay the staff formerly working on these projects, you would charge to the PPP as well as the associated overhead. So in this case, your program, you can't reasonably charge the cost reimbursement award because there's no work ongoing. So in this case, you would charge the PPP. One thing to think about here is the timing. So if you did have an established emergency policy, this would allow you to charge the award prior to the funding of the PPP. You could take advantage of the PPP for the 8 weeks to pay the employees that are on these contracts so that work is not ongoing. And then once the 8 weeks is up, if you send to the funder to get approval, you can then also charge the cost of pausing and restarting the award after that 8 weeks is up back to the federal award. And then in terms of fee for service, any of the payroll costs and associated overhead for these programs for staff that can no longer generate program service fees to cover their operating costs would be charged to the PPP. And then we'll jump into polling question number 4 for time purposes real quick.
How many weeks of costs does the PPP as currently stated cover? 6, 8, 12, or 16? And we're going to close out in just a second. Get that last polling question answer in. All right, closing out.
And it looks like most people got this correct in that it is an 8-week period. We are waiting to see if there's any additional extension, but as of right now, there's been no extension on that period. So the next consideration is your award is ongoing. So if there has been no closure of the award or it continues, albeit in a limited capacity, continue to charge costs for staff payroll that are reasonable and necessary for the performance of awards to those associated projects. One thing to consider here, though, is the level of effort that you are putting on cover awards if you are going to continue to charge them. Some key questions to look at is whether or not you can continue the effort required on this award with fewer employees and then allocate the excess staffing to PPP to be forgiven. Can you benefit from putting additional staffing on the award? So can you put more employee manpower onto your covered projects and benefit the award? If the award is ultimately benefiting from the additional staffing, you may be able to charge those to the federal award instead of PPP. And does your contract allow for work stoppage? If there is stoppage allowed on these contracts, you can consider exploring deferring some of the work done by employees on the award with possible extension from the funders. In terms of extensions, OMB M 2017 has allowed awarding agencies to extend awards that were active as of 3/31/20 that were going to expire for up to 12 months at no cost. The caveat here is you have to reach out to your funders in order to get this extension. And another thing to consider for organizations would be to reach out to funders about possibly rebudgeting costs to cover additional non-payroll costs that would not normally be chargeable to PPP, these non-payroll costs, since they're limited along with that award extension. For fee-for-service awards, this is where it gets a little tricky on where you should and shouldn't be charging fee-for-service awards between PPP and the award. The first consideration is whether or not the fee-for-service is based on a budget and estimated output. So in some cases, you're taking an estimated output that your funder expects you to do divided by the budget, and that's your fee-for-service. In essence, that's cost reimbursement per unit, just under a different formula. So if, the other consideration here is if it's based on the budget, consider whether or not this budget considers overhead costs. So if your fee for service only includes payroll costs, then overhead costs are excluded and you can charge those to the PPP award without consideration. The other thing with the budgets is whether or not they're considering incremental costs. So a lot of organizations are running into situations with hazard pay or unexpected overtime or just general increases in costs for maybe they brought on additional maintenance staff to keep environments sanitized. If these aren't included in your original budget, which the fee for service award is coming up with your unit price, then those costs would be reasonable to charge to the PPP. So what you should look at here for ongoing programs is what level of drop-off have you had for your program service revenues. So if you were budgeted to be at $2 million, for example, to cover the program costs, and now with COVID-19, your revenues have fallen to $1 million, there's been a 50% reduction in what would you consider revenue that would have been used to cover your payroll and overhead costs. So in this case, we would recommend charging that 50% reduction to the PPP and the remainder to the award. So when you're looking at it, you can either look at shortfall in units of output if you do have a specific units of output listed in the contract. But in cases where there's not a specific unit of output, look at your budgeted revenues versus where you actually come in at. So we're going to open up to general questions now. We went through that kind of quickly just to try to get more of the questions that everyone wanted that are more relevant.
Yeah, thank you. So James, why don't I answer some of the questions that came in and you can catch up while you're while I'm answering them. Well, we got I'm going to group a bunch of the questions together because we got a lot of similar questions. So one was the slides. Ashley will talk about we can distribute the slides and make them available. I think they're available now, but if they're not, Ashley will address that in a few minutes. Then we'll turn to the payroll period. Got a lot of questions about what happens if my payroll period doesn't align with the 8-week period. And so I hate to keep saying this, but it's not clear. We don't have guidance on this yet, but here's what we think. The intent is to cover 8 weeks of payroll. So if your payroll cycle, let's just say it's a week, you have a bi-weekly payroll cycle, it's off by 1 week. So the first week, a week into your 8-week period, you make payroll. That covers the week that just passed plus a week before the 8-week period. We think you should continue to make that payroll, and you've right at that point you've included one additional week outside the 8-week period, but that catches up at the end because of the last week of your 8-week period won't be covered until a week later. So in that case, you've still covered 8 weeks of pay as long as you pay in the ordinary course, and you have 4 payroll cycles that cover 8 weeks. We don't think they're going to make you prorate the first and prorate the last because it's a wash. It evens out. So as long as you cover 8 weeks of payroll, we think that will be sufficient. But we do believe it will be important to pay these amounts. That you can't rely on an incurred, an accrual type concept. We think they're going to require that the amount be accrued and paid. But we have to see how the guidance comes out on this point. We just don't know at this point. But as of now, we don't think they're going to require a complex calculation of prorating the first and last payments. Another question came in about related party rent. Nothing excludes related party rent. So as long as there's a lease, hopefully a written lease, and it's in effect before February 15th, that should be fine. Working capital loans was another question we got. As long as the working capital loan has a UCC or a lien filed, it seems to be a covered mortgage. So that would be fine. We got questions about copiers and leasing copiers and stuff like that. That would seem to be a rent payment within the definition of rent. So those types of things likely will be covered. We'll see what happens when the final guidance comes out. Got a bunch of questions about the forgiveness process. No, there's no application as of yet, and there's no specific calculation that needs to be required yet. We believe that will come out in the guidance in the next week or two, at least the calculation, how it's to be done. Whether each individual bank has a specific format they want you to use, we don't know. We have not seen one from any bank yet. It's too early at this point for banks to be coming out with that type of information. We think they're going to wait for this guidance as well and then develop their own process for application. It makes sense that each bank would want to standardize the process. If I were the bank, I would submit a standard form, and I'd want everyone to use the same form. So when they review, 30,000 applications for forgiveness, it's certainly a lot faster if they all look the same, and the bank can go a lot quicker. So I imagine there will be some kind of application that each bank will produce, and there are likely to be great differences between those applications. So that I think it's too early to know that kind of information. We expect it'll come out in the next few weeks, but most certainly since it will be relevant. With that, I'll turn it over to James to answer a few questions, and then when he's done, I'll come back and answer a few more.
Okay, some other questions that I'm seeing in here is what do we mean by single audit? So single audit would be whether or not you would have to report the costs on your statement of expenditure of federal awards. This is looking at whether or not you would need a yellow book or full audit under uniform guidance. This is separate than the $2 million threshold that the Treasury Secretary has mentioned. So if your PPP loan is over $2 million, there is still a chance for audit based on the guidance that we've heard. But in terms of single audit, this would not be included for entities that do have a CFA. PPP funds would not be included in that CFA. In terms of what awards to consider for PPP, we would consider federal grants, state and local grants, as well as any kind of foundations that have specified budget and reports that you have to submit to foundations that are restrictive and that would want a report on their costs. So I'm just going through real quick. In terms of who is forgiving the loan forgiveness you'll apply with your bank, and the bank will make the decision as the conduit with the SBA. And again, another question we got was in regards to headcount and voluntary turnover or involuntary or disability. So the facts and circumstances here will kind of cause some of these items to change. In terms of people having voluntary turnover, unfortunately on this end, and Dan, you can weigh in on this one, would be voluntary turnover would reduce your FTE count.
Yep. Yeah. This is another question that came in on a similar point. What if an employee, their term of employment was expected to end, and so therefore they're not included in the 8-week period? That would give rise to a reduction in FTE count because nothing allows for that. And they don't distinguish anywhere in the guidance, the statute or the IFR so far between an employee resigning, getting fired for cause, getting laid off or furloughed. The only thing is that FAQ 40 that talks about layoffs and people who don't want to return to work, but there's nothing there. A couple other questions I'll address that came in. How to calculate FTE count, we addressed that. There's really no guidance. We think it's a 30-hour concept based on, I told you, those old slides that are online from the SBA. The IRS also uses a 30-hour rule, so that's consistent with the SBA slides. It's likely that's going to continue, that 30-hour test I talked about earlier. Again, 2 buckets. 30 hours and above counts as 1 FTE, take them out of the mix. The rest, everyone under 30, put in one big calculation, add up the hours and divide it by 30. And that'll give you a number of FTEs for all those people, and then add the 2 buckets together. Employee, the question is what's the relevance at February 15th date? Why do they limit expenses, overhead to items that were incurred in place before February 15th? We don't have an answer to that. I believe the reason was they wanted to prevent fraud, and they wanted to prevent a lot of new related party leases coming in or people to put for overhead expenses. So the thought was if a rent or a loan or a utility was in effect before February 15th, there was no way that was done for purposes of gaming the system for the CARES Act. Since the CARES Act came in the end of March, someone couldn't have known by February 15th that this crisis was going to happen. Someone couldn't have known that the CARES Act was going to be passed. So there's some measure of credibility with that kind of expense, that if it's in effect on that date, it wasn't done for purposes of taking advantage of the act. So that's likely the reason they have that February date. Another couple questions came in about should funds be kept in a separate account. There's no requirement to put your PPP proceeds in a separate account. We do recommend that clients do that. And the reason is just for tracing of funds. We think it will be easier to establish to your bank on the forgiveness calculation that the use of the funds, that it was used only for permitted purposes, so you didn't violate the loan covenants. Also, we think it'll be easier to document the forgiveness. Now, we're not suggesting you make your payroll, for example, through that bank account. You can certainly make payroll through your operating account and use the PPP account to reimburse your operating account, right? It's just moving the money from your left pocket to your right pocket. But you will have a nice audit trail at that point of how the money was used. No one can allege you used the money for an improper purpose, and you have nice, clear tracing of the funds, the PPP funds, and they were spent on forgivable expenses. Last question I'll address, we're turning it back over to James, is returning the funds. Can the funds be returned without penalty? The answer is yes. Obviously, you have to pay interest up until the date you return the funds. But this question kind of gets at 2 points. One is, what about people who spend what they can spend during the 8-week period? And let's say another 6 months go by and they decide we don't need the money any longer. They can pay it back at any time. There's no prepayment penalty of any kind. That can be repaid at any time. So that's sort of the typical case where people don't use all the money. They find they don't need it for another 2 years, for the remainder of the 2-year period, so they pay it back. The second class of people, and we have a lot of folks in this category, is they're concerned that they didn't qualify for the loan in the first place, so they want to return the money now. But by that, there's a May 14th, a May 14th safe harbor period that a company or not-for-profit can return the money. So let's say they violated the 500 headcount rule, made a mistake and said they were under 500. You can return the money by May 14th without penalty. Let's say they violated the affiliation rules, or they had access to capital and liquidity and therefore didn't think they could adequately make that representation that the current economic uncertainty made the loan necessary to support their ongoing operations. Those people are in that same category. May 14th, you return the money by then. It was May 7th. They extended the date a couple days ago to May 14th. If your money's returned by that date, then that rep will not be considered violated. So that's called a safe harbor period. So there are a bunch of people who are reanalyzing their entitlement to the loan and considering whether to give the money back by that safe harbor period, not use any of it. So that's a second class of people thinking of returning funds. James, back to you. We have 1 more minute left. We'll turn to James,
Okay.
and then Ashley, if you can address the slides.
Okay, I'm going to run through 2 more questions. One was a situation where you have a fee-for-service contract or a contract with a local and state agency. Instead of billing them for the 2 months to use the PPP fundings and then afterwards start charging that award again, we would recommend, if you are putting effort onto the federal, state, local awards, that you do charge those entities if you are using the program personnel for that. I mean, ultimately, what would happen is you'll end up in the same position, most likely, because they're funding that same payroll as the government agency. So you would still be made whole at that point. So if you can't reach to them, get an extension, we recommend billing them if you did incur work on that award. And the other question was, in terms of program service revenue drop-off, if it's only during those 8 weeks. We would recommend a holistic approach, looking at the entire time frame from when the public health emergency started, probably in either February or March, to the point that you're going to apply for forgiveness, to see what kind of revenue drop off you had, rather than just in that sample 8-week period. This would give you a more representative look at how much your operations were affected when you go to charge that.
Great. So Ashley, do you want to address the slides as well, in addition to this final polling question?
Yes, perfect. So you guys go ahead, answer the trivia question for a chance to win a prize. The handouts they are in the section off to the side on your toolbar. So under the section that reads handouts, you will see all of the slides within there. You'll see our presenters here today, their bios, and that's all downloadable for your use.
The responses are pretty close to even on this polling question. And I got to confess, I don't know the answer to this one either.
James will reveal the answer in just a minute when I close it out. Yeah, it is pretty even. I'm not sure which one's going to come out on top and which one's the truth. All right. I'm going to close it out.
Is it closed now?
Closed out.
Oh. Okay, so here the answer is "Can't Stop the Feeling" actually was not used yet for a culture video.
Awesome. Alrighty, thank you guys for answering that. Like I said, off on the toolbar, you can find the slides from today as well as the bios of our lovely presenters here. Hopefully it was super informative and it's helping you along your new road and getting used to the new normal. We thank you for attending. If you have any other questions, feel free to reach out. My contact information is made available for you, and continue staying safe. Thanks, everybody.
Thank you, everyone.